I now recognize myself for 3 minutes to give an opening statement. The CFPB undoubtedly remains the single most powerful and least accountable federal agency in all of Washington. When it comes to the credit cards, auto loans, and mortgages of hard-working taxpayers, the CFPB has unbridled discretionary power, not only to make those less available and more expensive, but to absolutely take them away. Consequently, Americans are losing both their financial independence and the protection of the rule of law. The Bureau is fundamentally unaccountable to the President since the Director can only be removed for a cause. Fundamentally unaccountable to Congress because the Bureau's funding is not subject to appropriations. Fundamentally unaccountable to the courts because Dodd-Frank requires courts to grant the CFPB deference regarding its interpretation of federal consumer financial law.
I was here when we passed Dodd-Frank, and I actually carried the exemption for auto dealers. And so I was a co-sponsor of it. I remember it and was involved in the discussion of it. And what I am concerned about, sir, is just doing an end around. Okay, that, well, we do have jurisdiction over lenders, and therefore we're going to, scrutinize and make sure that there's no disparate impact by some lending that the lenders do to the auto dealers, because the auto dealers, they negotiate on price and they negotiate on rate. That's how they do it. Mm-hmm. And so what I'm concerned about is CFPB stepping into something that I consider to be the purview of the Department of Justice. Whether or not there is some discrimination in setting rates, there really is something they look at on a continuing basis across a whole variety of fields. But I would just ask you all to stay in your lane.
But so do we. On the Equal Credit Opportunity Act, both the Justice Department and the CFPB have enforcement authority there over lenders. We have, as I see it, we have a responsibility. Congress told us we have that responsibility. We do not have authority over dealers, and we've been careful not to exercise that.
And that's why I'm saying to you, I appreciate that, but I also see this as kind of an end around. That, okay, I'm just...
Yeah, I
don't
think so.
Look,
We
I'm
try
not
to be very, very careful.
No,
I understand.
I'm telling you my perspective on it.
I got it. Yep.
And so that you understand why I've carried or co-sponsored some legislation to make it clear that this is a place, in my opinion, for the Department of Justice, given what we did in Dodd-Frank. And I guess my question to you is, does CFPB, is it something you desire that in effect there be a flat rate and that really auto dealers only negotiate as to price, everybody gets the same rate? I mean, there are some in the industry that think that might be simpler, easier way to go, but many in the industry like to be able to negotiate on both levels, believing that it helps the consumer. Maybe it does, maybe it doesn't. We've all been in negotiations at auto dealerships. It's not a lot of fun, but you can work through it.
Yep.
Are you all focused on just trying to get a flat rate?
That would be one of the ways in which this issue could be resolved, but we've come to understand that that's by far not the only way. We've been open to other suggestions, and people can have a compliance management system that feels to me pretty onerous and burdensome. I do think that when the customer comes into a dealership and the dealer gets a buy rate for the customer and then marks it up without the customer having any idea what's going on or why that's happening, that's problematic. And the Justice Department and we both believe that this has caused a certain amount of discrimination in the market. And it's something that should be addressed. But flat fee is not the only approach. I think there's a number of possible approaches, and we've talked to lenders extensively about this. And to the extent dealers have wanted to talk to us about it, we've listened to them as well. But no, that's not the only means by which this can be addressed.
Okay, well, I would like to work with you all. I know you're familiar with the Charles River study, which calls into question the methodology of the CFPB. And I just think we should be able to work this out, but if we can't, then I'm going to continue to pursue the legislation that I've co-sponsored in the past.
I understand that.
All right, thank you very much for your time.
Thank you
for your service.
Thank you.
Thank you, Chairman. And thank you, Director Cordray, for your testimony today. I'm a small business owner. I'm one of those. I'm an auto dealer. My father bought his first dealership when I was very young after moving to Texas to start a new life for his family. When I got older, I chose to follow in his footsteps and have been in the automobile business for 44 years. Now my daughters run the business. Last week in a Bloomberg News story, you insinuated that auto dealers' base financing rates are on eyeballing a customer and that the practice was regrettable. Let me tell you a quick story, and you've heard some stories like this. I had a single mother come into my dealership not long ago. She didn't have a lot of money for a down payment, but her credit was poor, and she had been turned away by her bank, but needed a car to get to work, needed a car to take the kids to school. Well, guess what? We didn't judge her based on the color of her skin, her ethnicity, her gender. Our job that day was to get her into a car that was reliable and that she could afford. Now, myself, like everybody else in my industry, we've got hundreds of stories like this, and most come out really, really well. And in my business, I have found through the years I've been in business, you have one thing at the end of the day when you go home and lock the door, and that's your reputation. And I wouldn't trade that for anything. Now, Director Cordray, Congress has directed by statute that the Federal Reserve Board and the Federal Trade Commission regulate dealers when engaging in direct vehicle financing. Congress has also empowered the Federal Trade Commission and the Department of Justice to bring enforcement actions against auto dealers. All 50 state attorney generals, as you would know, also enforce the applicable statutes against auto dealers.
Yeah.
So a question I have is this. Do you recognize that in Section 1029 of the Dodd-Frank Act, Congress preserved the exclusive authority of these agencies to regulate auto dealers at the federal level?
Yes, and we've been very careful to observe that line, very careful.
Well, I hope you mean that, because sometimes we don't feel it.
Okay, but we have been very careful.
All right.
We didn't even talk to auto dealers at all until they came to us and wanted to talk to us a bit about this whole marketplace. So I think we've not brought any enforcement actions against auto dealers other than buy here, pay here, which is within our statute. We don't supervise any of them, and we recognize the jurisdiction there lies, as you say, with the FTC, the DOJ, and of course, as you say, with the states.
Okay. Second question, do you further recognize that any effort by the Bureau that may impact auto dealers must be fully coordinated with the appropriate federal regulatory agency in advance of that activity?
So we work closely with the Justice Department in the area of enforcing the Equal Credit Opportunity Act, and that's as it applies to auto lenders, not auto dealers, where we do have a responsibility. And I think there's quite a bit of coordination there, yes.
Third question, when the March 2013 auto finance guidance was issued, did CFPB consult with the FTC, the feds, or the Justice Department beforehand? And if not,
I know that we have pretty constant communication with the Justice Department. As you no doubt have seen, we've taken joint enforcement action with the Justice Department in this area. I believe we've also had coordination and consultation with the FTC. What exactly would have happened when that came out, I don't recall offhand now, but I know there has been discussion back and forth about these issues, recognizing that our jurisdiction is limited and others have jurisdiction that we don't.
Mr. Chairman, I remind my colleagues that over 5 years ago, the dealer exemption in Dodd-Frank was vigorously debated and passed by Congress and passed this committee. I think it's irrelevant whether or not a member is for or against CFPB eliminating dealer discounts in the showroom. Congress has spoken clearly on this issue. I find it incredible myself that an agency which under federal law has no supervisory, enforcement, or regulatory authority over auto dealers is still attempting, I believe, to dictate the manner in which auto dealers are compensated and how much they should be compensated for facilitating auto loan for their customers.
So I just want to be real clear on this. As I understand the statute, and we've looked at it very carefully, we have a responsibility and we have jurisdiction over auto lenders. We do not have a responsibility, we do not have jurisdiction over auto dealers. To the extent that they're combining with each other, we still are responsible for governing auto lenders and their compliance with the law. And we will continue to do that, and I think we have to do that vigorously. So beyond that, you know, we've tried to be very mindful of the jurisdictional issues here, but the notion that We have a responsibility with auto lenders. It may have some effect on auto dealers, but that's the way the statute was written. That's how I have to enforce the law. If Congress changes the statute, then of course I'll follow the statute as Congress might change it.
Thank you for being here today, Mr. Chairman. I yield back.
Thank you, Mr. Chairman. Welcome, Mr. Cordray. It's not every day I have a constituent testify, so it's good to have you here. And apparently it's Central Ohio time because Ms. Beatty went, and now I'm going, and in the back you'll see some folks from the Mid-Ohio Food Bank in Grove City, your hometown, that I'm going to meet with after this. But I want to thank you for what you're doing to try to protect consumers. But I will tell you, I do have some concerns about some of the methods your agency is using. And I'd like to kind of, if I have time, talk about auto dealers, prepaid, and then if we get to it, TILA and RESPA.
Okay.
So you may know that the Department of Justice has created a framework, and I think both the national automobile dealers and the minority-owned the minority auto dealers have developed a fair credit compliance program around the Department of Justice model, but I don't think any of that was used in the CFPB rule you're creating around participation of auto dealers. And I'm just curious, do you think the DOJ model doesn't work, or it's not good, or did that just not enter into your thinking?
So the way Congress drew our statute, again, this is another area where supposedly we're so powerful, but we do not have jurisdiction over auto dealers.
But you have,
and we've been
you
careful.
you do have, and you're working on getting information on their participation with lenders. So you're using the lender to get into the dealership.
Now, we have responsibility to oversee fair lending by auto lenders, but not by auto dealers. So that the dealer program that they've developed may well be an excellent program, and we've talked to them about it at their suggestion. It's really more for the Justice Department to say what they think of that, not really within my jurisdiction.
Well, I do want to share that I talked with one of my auto dealers, and they gave me some stories about some folks from my area, your area, that actually got car loans through work at one of the auto dealers in our town, Reichert Automotive, just down from where you live. And a lot of college students, a lot of first-time buyers, a lot of people with damaged credit have actually been able to secure car loans. I want to tell the story of a lady who needed a car to get back to work. She was a young lady in her 30s, recently divorced. Her husband had ruined their credit. She had 3 children. She needed to get back to work. She couldn't find a loan to get a car, and that dealership helped connect her with a lender that gave her a loan. And I think that's a really good outcome, but they are worried that under your proposed rules that, you know, they might not be able to work with that lender to help increase the competition and get people like this lady that needed to go back to work alone. So
Yeah, I actually agree with you on that.
Yeah.
I think it is a good outcome. I think people need, at least where we live, people need cars to be able to transport themselves to work and keep a job. If they can't do that, it's worse than having a mortgage problem because they can always rent if they don't own a home.
Right.
But here they do need these loans. And I do think the auto industry is going gangbusters right now. Sales of cars are up.
it is, but there are
Lending is-
people who can't get access to loans right now in cars because
Yeah.
if you can't get access
Well,
to a loan, you can't get access to a car. So
Certainly don't want that to be as tight as
I
the
certainly
mortgage market is
wouldn't
big
want
time.
your unintended consequences to be that you allocate,
Fair enough.
loans away from the people who are most in need.
Fair enough. It's
And,
not
you
what
know,
I intended.
I would use the Soviet grocery store as an example. Sure, a Soviet grocery store never sold anybody bad vegetables or bad meat because they never sold anybody vegetables and meat.
Yeah.
They were always out of it.
Yeah.
So you can, that's not the right way to protect
That's right.
consumers. So
That's not what we
it's
intend
really
either.
important that,
Yep.
that I get that across.
Thank you, Mr. Chairman. Thank you, Director Cordray, for spending your afternoon with us today. The gentleman from Colorado, Mr. Perlmutter, mentioned the Charles River Associates study. This is a research paper from November that examined the Bureau's disparate impact methodology for indirect auto lending. As you may recall, the study concluded that there were significant flaws in the Bureau's methodology that led to an overestimating of minority populations by as much as 41%. To date, the Bureau has yet to publicly acknowledge the study. Can you comment on whether you would agree with the conclusions of the report that the Bureau's methodology is error-prone?
Yeah, we don't agree with the conclusions of the report, and we've looked at it fairly carefully.
Has the Bureau, have the results of the study caused the Bureau to undertake any changes or consider undertaking any changes with respect to its fair lending investigations or evaluations?
So we actually sat down and had a discussion with the folks from Charles River and the sponsors of the study to both discuss the study and be presented with the results. We have looked at the results pretty carefully. We don't find some obligation to respond to the studies out there all the time on all aspects of our work, but as we always will do with any kind of analysis of data, we've looked carefully at it to think about what it might mean for our program, and that's where we are at this point.
So you're not, are you going to make changes or not going to make changes, or you're considering making changes?
I think we're still looking and thinking about that study, but I don't know whether we're going to make any
Would you
changes or
find
not at
some
this
merit to
point.
the conclusions of the study or no merit to the conclusions of the study?
I don't want to try to turn it into some subjective judgment. The people who work on this stuff are more expert than I. I think we disagree with the results of the study is what I would just say.